All right, welcome to the Explainer. Okay, let's just dive right into this. If you've been paying any attention at all to the cryptocurrency markets over the last few years, you already know it can feel completely like the Wild West. I mean, we've seen massive bull runs that literally minted millionaires overnight, and on the flip side, we've seen brutal crashes that wiped out entire portfolios just as fast. The graveyard of crypto investments is basically packed with people who chase the wrong token at the absolute worst time. So today, we are unpacking a really grounded, methodical approach to surviving and honestly thriving in that exact chaotic environment. We're breaking down a specific framework created by the YouTube channel, TheAbrahamCryptoLand. And look, this isn't about getting rich quick by next Tuesday. It's a deep dive into the investor's mindset and a total masterclass in building a strategy designed specifically to survive the madness of the markets.
40%. Seriously, think about that for a second. In a market known for tens of thousands of different coins, countless new daily token launches, and just absolute frenzy, why on earth would an investor choose to dedicate nearly half of their entire portfolio to just one single asset? Human psychology in the crypto space is so heavily driven by FOMO, the fear of missing out. It is incredibly tough to ignore those shiny new coins promising impossible returns. So allocating 40% to just one asset, that seems like a massive, undeniable commitment that totally goes against that rapid-fire, high-risk crypto culture we're used to seeing. Let's find out exactly why they do it.
Well, the core thesis of the TheAbrahamCryptoLand is actually pretty simple, but it is fiercely disciplined. They make Bitcoin the absolute foundation of their portfolio. Think of it kind of like a giant sailboat in the middle of a massive storm. Without a really heavy weighted keel sitting deep beneath the water, that boat is going to capsize the second a strong gust of wind hits it, right? By anchoring their investments with this massive 40% allocation in Bitcoin, this creator is intentionally building that keel. They're actively trying to manage and mitigate risk in a space that is just inherently volatile. They're prioritizing survival over that classic lottery ticket mentality.
So here is our roadmap for today. We're going to look at the 40% foundation, how to avoid the hype trap, the 4 pillars of strategy, and finally, why mindset triumphs over market predictions. Let's get to it.
Part 1. The 40% foundation, anchoring the portfolio. Let's dig right into the pragmatic reasoning behind taking such a large position in a decentralized market.
Okay, so here's where things get really interesting. How is the total portfolio actually balanced? It functions essentially like a strategic seesaw. While you've got that massive 40% locked firmly into Bitcoin to act as the anchor, the remaining 60% isn't just sitting in cash or randomly scattered. It's deliberately spread out across a diversified basket of smaller cryptocurrency projects, which we know as altcoins. Now, altcoins generally carry way higher volatility, sure, but they also have significantly higher growth potential than Bitcoin. This specific 40-60 split is systematically designed to balance out the overall risk profile of the entire portfolio. You're using the 40% to preserve wealth and the 60% to aggressively grow it.
But, why does Bitcoin take the crown here? Well, our source highlights some super pragmatic reasons for making it the largest position. For starters, it's the #1 cryptocurrency by market cap, which means it has the most liquidity and institutional adoption. But even more importantly, it offers the highest level of security and stability within this specific market. And look, in the context of crypto, stability basically means it has survived multiple brutal, multi-year bear markets and actually recovered. It is battle-tested in a way that literally no other digital asset is, making it just the most logical choice for capital preservation.
Now, back to that 60% we just mentioned. This investor doesn't just put on blinders to the rest of the market. They simply scale their exposure. The rest of the portfolio includes a diversified mix of altcoins, like Ethereum, Bitcoin Cash, XRP, Solana, BitTensor, Aster, and Linea. And these aren't just random dark orb picks. They represent totally different utility sectors like smart contracts, payment networks, and artificial intelligence. By spreading capital across these specific projects, they capture potential growth in emerging sectors while ensuring that, hey, if one network completely fails, it doesn't sink the entire ship. It's that classic don't put all your eggs in one basket rule, but applied directly to the frontier of finance.
Which brings us to part 2, avoiding the hype trap, reality versus emotion. Now we're shifting our focus to the psychological side of investing, specifically tackling the dangerous allure of chasing the newest tokens.
This really comes down to the fundamental difference between, say, planting an oak tree and lighting a firework. A proven asset develops deep roots over many years, it weathers storms, and it slowly compounds in value. On the flip side, you've got a shiny new token that might explode in this massive flash of color and excitement, but those gains, they're almost entirely short-lived. Our source maintains a strict need to stay realistic here. They actively refuse to assume that every new project is automatically the next Bitcoin.
Recognizing that difference between true fundamental value and just passing excitement is exactly what keeps an investor from getting burned when the firework eventually fizzles out.
Because here's the harsh reality of hype cycles. Initial momentum almost never equals long-term value. I mean, we see it constantly, right? A massive price increase right after launch, driven entirely by social media frenzy and the dopamine hit of watching a rising green candle. But hype is an emotion. It's not a business model. When that hype inevitably fades, when the early adopters take their profits and the social media chatter dries up, many of these projects just plummet. The developers abandon ship, the momentum completely vanishes, and retail investors who bought at the absolute peak are left holding bags that may literally never recover.
And that brings us to this exact quote from the source, which kind of acts as a gravitational law for their entire strategy. Higher potential return should always be balanced with higher risk. Simple, right? But absolutely crucial. If an asset promises a 100 times return on your money, you have to assume the risk of that asset going straight to zero is equally high. This is the foundational anchor of their reasoning. It perfectly explains why newer, high-hype cryptocurrencies only ever represent a much smaller, incredibly carefully managed percentage of this investor's overall portfolio. You can absolutely take the gamble, but you have to size the bet according to the danger. All right, part 3, 4 pillars of strategy, building the framework. Let's transition from the assets themselves to the strict, disciplined rules used to manage them day in and day out. You know, as humans, we are quite literally wired to look for patterns, which makes us desperately want to predict what a market will do next. But this strategy completely replaces that exhausting game of prediction with a super solid, reliable framework of rules. Step 1 is preparation. Step 2 is diversification. Step 3 is discipline, and Step 4 is risk management. Let's see how setting these 4 rules in stone actually protects you from your own worst impulses.
So let's unpack these. Preparation means actually doing the homework, reading the technical docs, understanding the tokenomics, and planning your entry and exit strategies long before you ever click the buy button. It means operating on data, not just definitely not just some late-night social media tip. Diversification, as we've already explored, is the active reduction of risk by spreading capital across uncorrelated assets. But discipline? That might honestly be the hardest pillar of all. Discipline is fiercely following the plan you made during your preparation phase. It means sticking to your stop losses, taking profits when you said you would, and completely avoiding the urge to revenge trade when you take a loss. And finally, risk management is your ultimate safety net. It's about sizing your position so that no single bad trade can wipe you out, ensuring you always have enough capital left over to play the long game.
And finally, part 4, mindset over market predictions, the investor's real edge. This is the ultimate thesis of our source material today.
Listen to this one and really let it sink in for a second. Nobody knows the future. I do not build my portfolio around predictions. Think about how incredibly liberating that statement actually is. So many retail investors suffer from this illusion of control. They think they can outsmart market algorithms, macroeconomic shifts, and huge institutional whales. But look, whether we are talking about Ethereum, XRP, Solana, or even Bitcoin itself, nobody knows exactly what price they're going to reach tomorrow, next week, or next year. True foresight is just impossible. Accepting that predicting the market is a fool's errand allows you to stop stressing over 5-minute price charts and start focusing purely on executing your system. So, the real why behind the Abraham CryptoLand channel, it isn't about claiming to be some kind of untouchable market guru. The goal is to literally document their own investment decisions, their strategy, and their mindset as a form of a public investment journal. There's this fascinating psychological phenomenon where people behave way more rationally when they know they're being observed. By recording their decisions, explaining the strategy out loud to an audience, and reflecting on the actual outcomes, this creator enforces a deeply systematic approach on themselves. Public accountability forces rationality over emotion. It drastically reduces impulsive trading errors because suddenly every single move has to be justified out loud. Now, as super crucial reminder regarding everything we've looked at today, this framework is a masterclass in risk management and personal discipline, but it is not financial advice. The content from our source and this explainer itself is strictly for educational purposes, reflecting personal opinions and experiences. It is absolutely not a guaranteed mathematical formula for making money, and you must always do your own rigorous research before you even think about deploying your own capital into any market. Well, that brings us to the end of our explainer today. But before we wrap up, I want to leave you with a question to reflect on regarding your very own financial habits. Take a hard, honest look at how you operate and ask yourself, are your investment decisions driven by careful preparation, or are you just blindly relying on prediction? Thanks so much for joining me on this explainer today. Keep learning, stay disciplined out there, and I'll catch you on the next one.